Hello everyone and welcome to another market update. Today is Tuesday, the 1st of October. Happy October, happy 1st of October. Top three things today are going to be stimulus and what's happening with stimulus around the world, commodities, what that's going to do to those markets, and finally growth and what that looks like now that we're in quad 2 sort of globally, but quad 3 in the US. So first thing is stimulus. There's a couple ways that governments and economies get stimulated. Well, the governments stimulate economies. The first one is to just flat out print money, and that's something that the US has been doing now ad nauseum for years, printing lots of money, and they do that by raising and lowering interest rates, as well as through fiscal policy. Fiscal policy has been one of the main drivers of U.S. stimulus of late because the interest rate environment has been very restrictive or hawkish, as they say. But now, of course, last week we had the U.S. Fed doing a 50 basis point cut. I think I made some commentary on that in my last update. And it gave the markets a nice bounce, which was fantastic, and it has put a tailwind behind commodities, which I'm going to talk about in just one moment. But a couple of days ago, China has come out and indicated that they are cutting interest rates and stimulating their economy as well. And this is a chart of the Chinese equity market, the Shanghai Stock Index, and as you can see here, it went vertical as of the 27th of September. It just has been on an absolute rip-roaring tear. Luckily, we had some exposure to Chinese equities via an ETF called KWEB, and that's a Crane Shares, which is an ETF provider, one of their Chinese equity ETFs, and of course it benefited from that. And I expect that the Chinese bull market is really only getting underway, so I intend to hang on to that position with a view that we'll cash out of it at some point. Nonetheless, the Chinese are stimulating, the US is stimulating, the Europeans probably not as much, and certainly here at home in Australia, not as much either. We had our Reserve Bank, the RBA, come out and say no interest rate cut for you, and I think they will continue to monitor the inflation outlook. I suspect that it's the inflation outlook that is terrifying our central bank the most, which is why they are opting not to cut interest rates. I think our economy is broadly sort of doing okay as well. We're actually going to be entering a couple of quad 2s coming up here in the next 3 quarters. Quad 2 is the modal outcome. So if the economy is kind of doing okay and the interest rate setting is where it's at, which, as I've discussed before, in Australia, the interest rate setting we have right now is actually pretty normal. When I started in the mortgage broking business some 22 years ago or so, interest rates were around this level. They were a tiny bit lower, but basically they were around this level. Went up a little bit, came down a little bit around this, went up a little bit more, and really we only went to that zero bound when COVID came along. So our interest rate setting, believe it or not, is actually pretty normal and not outside the realm of normal market conditions. I'm talking about in Australia. In the US, it's also pretty much historical norm, and we will see if the Fed continues to cut. Now, there was an article today, I don't know if it's still on the front homepage of CNBC here, but the Fed did come out and say they were going to probably have smaller cuts going forward and still cutting, but just smaller rate cuts. I don't see the article anymore. It was there earlier. So we'll just have to keep an eye on that and see what the market prices in going forward. Interestingly enough, the Treasury markets, obviously they had a little bit of a preemptive pricing of the rate cut, but have gone up a little bit. So interest rates have gone up in the market. So the market is pricing higher interest rates. Possibly one of the reasons is that the market can see into the future. It is a pricing mechanism for that. And the market probably is figuring out that inflation is actually going to start rising again. And potentially that's what we're seeing in terms of the Treasury market, the U.S. Treasury market going up a little bit. In any case, there'll be more on that later. We need more time and space and data in order to really make make that call in the sense of interest rates going up. Now, next thing is commodities. Item number 2 is commodities. So we've seen an absolute rip in a few commodities. Copper has gone ballistic, steel, a bunch of other soft and other type of commodities like lumber, sugar, coffee. The only one that hasn't, surprisingly enough, is oil. Oil hasn't quite yet come out of the doldrums, and that it remains to be seen what will happen with oil. As you would know, for those of you who have watched a number of these, especially when I've talked about commodities, in particular oil, there's a big geopolitical function effect rather on oil. So with all the stuff that's now firing up again with Israel and Lebanon and Iran, I suppose if anything, really truly escalates in that region between some of those powers, or if Israel decides to invade Lebanon or something like that, you're going to get a geopolitical risk premium put into oil. And of course, as you all know, that is going to impact the inflation outlook going forward. So probably one of the nice things about the fact that the oil price has come down a little bit is that because oil affects and is involved in just about every part of our economy, or energy and oil and its distillates, diesel and all the things that are made from oil, plastics and so forth. It affects everything, the price of everything in our economy. So the fact that oil has been a bit on the lower side is good. The other thing probably to call out on the commodity side is, well, first of all, the CRB index, as you can see, copper almost going hockey stick ballistic, and the CRB index coming off a pretty significant low there in September, and really going up a lot in the last 20 days or so. So that's quite interesting to see that happening. Some economies that are typically your bellwethers for economic activity, like South Korea, they call it Dr. Kospi, you've probably heard me talk about that, have diverged. So Dr. Copper is a big bellwether for economic activity. It's just gone into sort of a bull market now, as has the CRB index. So again, it's just supportive of the global Quad 2 outlook, with China now stimulating. That's going to put a nice underpin on the commodities sector as well. Of course, we're early days in all of this, and we'll have to see how this plays out. But the stimulus and the commodities prices going up are fantastic. The other thing I was going to mention there was the Aussie dollar has also had a bit of a rip, and I'll just grab another chart of that and quickly look at it on my other screen here. But the Aussie dollar started off September probably around the 66.5 level thereabouts, and we're up at just over 69 cents to the US dollar. So we've had a nice 3 to 4 cent gain there, well, 3 cent gain, I guess, ish, which is a big move in the span of about 10 or 15 trading days. If we go all the way back to sort of August, we were sitting in that 64, low 65, 64 range. So we've seen a 4 to 5 cent appreciation in the Aussie dollar, which is going to translate into lower inflation figures at some point, because we import so much stuff into Australia, including one of our biggest imports would be oil and energy. But those of you who've been watching this for a long time know that. So growth outlook. So what does this mean for the economy going forward, global economy, etc.? Well, I said a little while ago in these updates that we were going into sort of a global growth expansion. We're going into an expansionary phase. And Quad 3, whilst I have in the past indicated it's not one of the best quads for investing, it is actually still okay for a number of sectors in terms of in being investable. You just have to know where to allocate capital to. So one of those sectors is technology. Another sector is things like staples, and energy is typically features in your Quad 3 as well, although energy hasn't quite yet confirmed it's in a bull market, but there's plenty of other places to currently be making money. One of the key factors in all of this global stuff going on is the devaluation of the US dollar, and I'm just quickly going to find there's a correlation table that I have shown in the past. There it is, the US dollar correlation table, because the mantra is if you get the direction of the dollar right, you're going to get the direction of a lot of other stuff correct. So as you can see here, everything on this table is showing a negative correlation. What does that mean? And that's over the short term. Even over a 30-day term, it's all turned negative, which will eventually flow into the 90 and 120 day. What does that mean? So that means if the dollar goes down, these things go up, and if the dollar goes up, these things typically will go down. And so with the U.S. looking to devalue the dollar, all of these things are going to continue to increase. If you're a precious metals investor, you would have noticed the price of gold, at least in U.S. dollar terms, not so much at the moment in Aussie dollar terms because the Aussie dollar has been appreciating against the U.S. dollar, but the price of gold has been going up. Price of oil has been going sideways to slightly up. Bitcoin and the cryptocurrency complex has actually caught fire. So crypto is a place where you want to have some capital allocated in every quad except for quad 4, which we've really just come out of in the last month. So as an example, for those of you that look at your portfolios, you may have noticed a ticker symbol that's recently been purchased, which is MSTR. That's a U.S. equity. It's a company. It's a guy named Michael Saylor, who is a huge Bitcoin guy and has bought a whole bunch of Bitcoin for his company. It lives on his company's balance sheet. So I have opted to trade or own the stock in his company as opposed to trying to own a leveraged product or some other weird product, an ETF with just straight up Bitcoin exposure, whatever, because his company share price moves dramatically around the price of Bitcoin, and it's been actually quite a strong position. So the ticker symbol for that is MSTR for Roger, the maestro they call him. MicroStrategy is the name of that company, and that is going to be the way that I give you guys exposure to the crypto complex without all the hassles of a wallet and going and having to get leveraged products sign off in the Interactive Brokers platform and all of that sort of thing. Plus it's massively liquid, and I can get out of that easily when the time comes. One other quick thing and call out I just might make as well is I am shifting portfolios to have a growth focus. You probably would have noticed some new ticker symbols showing up, VGT, XLK, the Qs, VUG, IWF. You want to have growth exposures in every quad except for quad 4. Quad 4 is kind of that quad where really nothing is going to work, and you want to be in short-term or short-duration treasuries or really defensive assets like that, or cash even for that matter. But for the next probably 3 to 12 months, we are going to be moving around the quad 2 and 3 and even 1 environment in the US and in Australia. Having said all of that, what you're going to notice if you do look into your portfolios is you're going to see larger positions in those growth exposures, probably somewhere between the 6 and 10% range of your capital, and you're going to see me dropping off and selling down all of these other little rats and mice holdings. So I have been scaling back on those. I'm basically, now that we are in a commodities sort of bull market, I'm going to be waiting for that to puff itself out a little bit over the next probably 1 to 3 months and exit those positions such as copper and the not the precious metals, well, we do have platinum in there, the rare earth metals, copper miners, and a few of these other ones that I don't really want us to worry about owning anymore. Because over the long term, and I'm talking 10 to 20 years plus, growth exposure is really where you want to live. So I'll have more to say about that as we go along and do this repositioning. But for the time being, we've seen some really nice growth in portfolios in the last sort of month, capturing and catching a lot of what this up move has given us thus far, which I think is going to continue as well. So I'm just going to ride this out and continue to see the green on the screen, as they say. I think that's probably about... one final thing, because I like to talk about volatility. One final thing I'll mention is the volatility index, and I do often show you this, so I don't know why I'd want to cheat you out of that opportunity in this update. I'm just going to drag it into my screen. Here we have the VIX, which, as you can see, is floating around that sort of 15 to 17 range, let's call it. And this is the investable bucket. As long as volatility continues to stay in this range, it'll probably drift a little bit lower, might drift a little bit higher, but as long as we're staying around the 17, 18 level or below, we're going to continue to be in a very investable market. So volatility is coming down, has come down. As you can see, there's been these big spikes back in August. I talked about this around the time that really created this volatility, created a really uninvestable environment, but the volatility's come out, and we're seeing less of these big moves like that. As you can see, there's been a couple here throughout August and September. But anyway, as you know, I talk about volatility a lot. And if I showed you some of the other volatility indices like the Russell vol and the NASDAQ vol, again, similar things are going on there where volatility is falling. It's in the investable bucket, and we want to be, because of that, we want to be in our growth exposures. So with that, I'm going to say have a wonderful rest of the week, and enjoy your school holidays. We're officially on school holidays as of Friday, and hopefully you're enjoying, if you do travel to work, the lighter cars on the road and all of that sort of stuff, and no school zones, at least for the next couple weeks. So with that, I will say have a wonderful school holidays and rest of the week, and I will update you. Oh, one last thing. There is a quarterly market update coming out. I think it's a mid-quarter update coming out from Hedgeye on, I believe, Wednesday, which would be Thursday our time. Once I watch that and consume that, probably be over the long weekend that I'll watch it a couple of times, and I'll have something to say about updating you on that next week. So have a good one. Talk to you soon. Cheers, everyone. Bye.